Hi, we're live with Rich McDowell again with Synergy One Lending. And I'm Alicia Brown with Black Swan team of Remax Town and Country. And today we're going to talk all about conventional loans. So we've kind of talked at this point up so far about credit, how to apply for a loan, how to interpret a loan. And so now we're going to kind of dive in a little bit deeper about the different types of loans and what you need to know about each of them. So Rich is here today, and we're going to kind of do a deep dive into conventional loans, everything that we need to know. So Rich, thank you so much for joining us and
No, absolutely.
sharing your wisdom upon us again.
Well, I obviously I appreciate you and Roland so much. You guys bring so much to the table. So glad to be on here with you, and hopefully everyone was able to get outside and enjoy the Blue Angels and the beautiful sunshine today. So
Beautiful day.
at any rate, yeah. So kind of what you and I've talked about with some files and even myself is I'm always surprised how many people come to a lender and say, well, I can't go conventional because I need to put 20% down.
Mm-hmm.
And I'm always taken back. Or, I ran into a scenario the other day where I was competing with a lender on a national level, and they were given this borrower an FHA approval, and the borrower had impeccable credit, great income, great everything, and I'm always taken back, like, oh, okay, maybe the client just asked for that. But part of our fiduciary responsibility, if you will, is to give clients options, which kind of goes back to, I think, a couple of weeks ago we talked about the mortgage coach and the different layouts and things like that. And so one of the things I did want to do today was kind of say, okay, let's just talk about the value of conventional financing in today's market.
Right.
And so I don't really necessarily want to dive too far into the FHA side, but believe it or not, there is a conventional loan program that allows first-time home buyers to put down 3%. And so what does that mean, right? And so you can go up to the conforming limit right now is a little over $505,000. So that gives you a wide range of homes that you can go to, and you don't have to put 20,000 or 20% down.
And let me clarify real fast. When you say conforming loan, so you're saying that to qualify for the 3% down with a conventional loan, the home loan can't be for more than 500,000. Is that correct?
That is correct. Anything over 505,000 is a jumbo loan, and then it takes us into a completely different arena. That being stated, is if you look at the average first-time home buyer, you're going to, typically the 250 to 350 range. Well, the positive right off the bat is, oh, I have 3% down. I don't have to put 3.5% down, because FHA requires, no matter what the credit score, 3.5% down. So right there, we've saved the borrower cash in their hand of 0.5%. And as you get into the $200,000, $300,000, $400,000 range, that's a little bit of money.
And that's fantastic, because like you said, typically, like, you just expect 20% with conventional, and that's what we've always been told for so many years until more recently. So that's great that they can even beat the FHA loan.
Absolutely. And then the other thing I always hear is, well, I don't want PMI. Well, if you have an FHA loan, let's talk about the two components there that are absolutes. You're going to have an upfront private mortgage insurance added to your loan. So it's an upfront insurance fee added to your loan. And that fee is 1.75% of loan amount.
Wow. Added
back to your loan. So yeah, now here you are, you put 3.5% down, but you are adding back in 1.75 to the amount financed. It's if you don't need the FHA, I think the conventional is a route that you need to at least look at. You can see with 3% down, you don't have upfront mortgage insurance with conventional loans. And depending on your credit score, that PMI rate could be less. In this particular situation that I was talking about earlier with you, is the FHA loan that I was competing against. Mm-hmm. Is 0.85 monthly is your PMI, no matter your credit score. In this particular situation here, their PMI was 0.66. So they didn't have to put 3.5% down. They only put 3% down, and then their PMI was 0.66.
Wow.
And so that saves them money. And then, as you know, with conventional loans, the PMI falls off after you have 20% equity in your property.
Which is fantastic.
So it's not for the life of the loan. It's not for anything. So now forward thinking for the client is, oh, this is our first home. We're going to buy the modest $275,000 house. Now that becomes an investment property. Let's just say, for argument's sake, the rate's 3.5%. That could be something that could cash flow them for when they do that move up, or hey, now we have kids, or whatever the case might be.
That's excellent.
Yeah. So the other positive in today's times for conventional is majority of the borrowers, when they qualify conventional, will qualify for a drive-by appraisal. So I don't know if you guys have seen that on your end, but Fannie Mae and Freddie came out a couple of months ago and said, hey, the drive-by appraisal will work. The value to us is now people are social distancing. Hey, I want to kind of keep how many people come into my home. And now you're setting that up on a drive-by, and you can get that done fairly quickly. And truthfully, from our end, we haven't seen values deteriorate by that. And
that was my next question. Have you seen any change to appraisals? Are they still able to get a pretty accurate appraisal without actually being able to get into the home?
I haven't had one, knock on wood, that has been less than what the contract states. And so, and again, if we go down that route on maybe going over appraisals one day or whatever, maybe we could even get an appraiser on with us to kind of talk about how they do that. But for the most part, when you have a willing seller and a willing buyer in a great neighborhood, and you guys do a great job doing the CMAs, that, you're able to say, hey, the value's 371, it comes back 371.
Perfect. Like you said, that's conventional. Can they do that?
That is correct. Yeah. So any other loans that go on through that, they're going to require full appraisals, and then it's met to certain standards of the interior of the home and things of that nature. And it can just slow it down, right? Because now I need to coordinate myself getting into a house, got to get the seller out of the house. Now they're freaked out that somebody else came into their home that they didn't know, and all of that sort of stuff, right? So, as we look at that sort of stuff, you want to just understand the positives of it. And to me, less money down, do the drive-by appraisal. It's something that a lender should give you that option. So I think too often we are afraid to say what options are out there. This is truly a first-time home buyer program that allows you to put the 3% down. And so kind of just to segue into a different market, well, what if I have done that before and now I want to sell, or I want to turn that into an investment? What do I have to put down? So conventional financing will allow for the masses of us 5% down.
Okay.
Down payment, closing costs, interest rates are all kind of tied to your credit score. I tell people, just from a simplistic piece, and I know we talked about credit, I think last week, is your credit score is kind of like your highway to buy.
Right.
So the rougher the credit score is, it's 6:35 on a Friday afternoon. If not fun, pretty well. In the past, it's been pretty crowded, right? The better your credit score is, now you're on the expressway, you're on the highways that you're able to just blow and go. Absolutely. And so, and I think when you look at it for the offer letters, when you get those as the listing agent, and you see, hey, this person qualifies 3 or 5% down at a 3.3 or 3.5% interest rate, that kind of tells you, wow, that's pretty good. This is a strong buyer, and it allows you to start separating. Say it again.
Yeah, it gives a sense of like calm and like, okay, yeah, we got a strong buyer, and they're like, okay, we're good. And
absolutely. So from the conventional aspect of it, 3, 5, 10, all will have PMI on it monthly. When you do get to the 20% down, PMI goes away. And so what we've seen a lot in the last couple of years is people will do the 5 or 10% down, and 2 or 3 years later, the PMI is gone because the values have increased so much. And so again, when you're looking at that, and I know you and I agree with this with some of our clients that we've dealt with, what is their plan 6 months from now or 3 years from now? Is this just our starter home? We want to get in here. We both have jobs in the North Texas area, so we kind of want to just be close to that. But eventually we might move into that move up home or that bigger home. And we want to position them that their house loan today doesn't impede that 3 years from now or 4 years from now when they decide to do that move up piece.
That's perfect.
Go
Did you
ahead.
have to say on that?
Well, I was just going to say on the down payment aspect of it, you can, structure that where the seller or the buyer handles the down payment, and you can have seller concessions, lender concessions, even where we say, okay, hey, yeah, your credit qualifies you for 3.3. Let's do 3.6. We'll give you a lender credit of a point. And now you got lender credits for your closing costs. You have the seller paying some closing costs. And you can get into a home very creatively with very little out of your pocket.
Yeah. And that's the nice thing is depending on each individual person's needs and kind of what their situation is, things can be crafted and moved around, and working with both the lender and the agent, like really making the situation work out to be the best for each individual person, because there's no like blanket, this is what's great for everyone. We kind of have to look at it case by case. And so just being really open about what you need is really helpful, because then we can help the best way possible to make sure that we can make it work. So
no, absolutely. And the other thing I would say on that is, and I was guilty of this, of going into a retail store and saying, oh, I'm just here. Yet you get out of your car, you park, you drive across town to go to the retail center, and you're saying, okay, well, I don't need any help. And eventually you're going to need help. Look at your lender as that person, and don't be afraid to say, hey, I saw this, or I'm hearing this. Can you explain to me either A, how that can happen or benefit me, or what would that be to sit there and say, well, it doesn't exist to you because it's a different loan, or your credit, or this or that. Have that in-depth conversation, because again, I stand behind this statement. This is the biggest investment, singularly investment, that a couple will typically make, an individual will make, is when you're making $200,000, $300,000, $400,000 investments. You want to make sure that and answer every question that makes you comfortable. And if you're not comfortable doing that with the lender, find a lender that you are comfortable with on that, because that should absolutely be, kind of a basic expectation of dealing with the lender is, well, I'd really only like to be out of my pocket $15,000 and a $1,800 payment. Where does that put me? Well, that's a $250,000 house typically, with taxes and insurance and all of that. And be able to explain that to them, and maybe show them the difference of, okay, that's $250,000, but if you went up to $300,000, now your cost is $18,000, but you really get what you want, and you don't have to put $20,000 into the house to update it. And that's the value of having that comfort level and commitment with the lender and the agent, right?
Yeah. We're all a team. We want to make sure that we can get you what you want, and happy with it and comfortable with the payment, like we've said before. We don't want to strap anyone or make them uncomfortable, and you got to enjoy the house. So you can't do that if you're stressed about money. So
absolutely. And then the final thing I would say, just on the conventional aspect of it, is you're going to get a loan approval letter from the lender that says conventional loan, XYZ down, close in here. And you can really dictate the strength of that to the listing agent, so that the buyer has the best chance to win. Because the one thing I would say through all of this COVID and all of that, the market is still moves rapidly. If you love the home, 2 other people love that home today too. And it might sit there for 60 days, but as soon as you fall in love with it, know that somebody else fell in love with it too. And you need the right approval letter to go to that listing agent.
No, I agree. A quick kind of like sidestep from that. I know that one thing that people always talk about is, in order to get approved for the loan, you usually have to meet a certain debt to income ratio. So can you kind of briefly explain what that means and then kind of what they need to be able to qualify to get into the conventional loan?
No, and that's a great segue for us. Is for us, we go off of gross pay. So this is pre your insurance, pre your 401k, pre your taxes. My gross income or salary $75,000. That's what we will go off of. Then we take your current debt that is listed on your credit report. As long as you've not acquired any new debt, car payments, retail centers, anything of that nature, we take that debt. And so I know a lot of folks come to us and say, well, I have $32,000 worth of debt. I might have too much debt. But if on that 32,000, your payments are only 320, we're only counting the 320 against your income, not the 32,000. And so what is typical, and everything is a kind of a moving target, but what is typically approved with no problem is a 45% debt ratio, and that's back end. So that's your house payment and all of your current minimum payments due equal in 45% of your max gross income.
Gross income.
And so even though you might put 10% into your 401k, and even though you have your medical, and even though you have all of that, we're going to go off of that number for your approval. You can go higher in some situations, but that's, I would tell you, kind of a rule of thumb. If you're looking at, well, what should I have for a payment for your home? 45% is a good kind of expectation.
Okay. And you said it's just stuff that's reported to on your credit report. So like credit cards,
automobile, credit cards, retail center, student debt, and any kind of revolving credit. It does not take into account your insurance, your child care, your groceries, gas, your running expenses. It doesn't take any of that in there. And so ideally what they want is 45% of your income used for house and debt, and then the rest of it's used for your utilities and your groceries and your child care and things that go on like that.
Perfect. And so that's where it comes into account, where to see what price home you can afford, because then the higher you get, then the higher that debt to income ratio becomes.
Absolutely.
Kind of sweet spot.
Well, and back when I bought my first home and we had kids and things of that nature, your child care, as we know with younger children, are extremely expensive. And so even though that doesn't show on the credit bureau, I personally know, hey, $1,600 a month is going out on child care, and I need to take that into consideration. Just because a lender says, hey, you can afford a $400,000 house, you know what your grocery bill is. Absolutely. Yeah. Absolutely. And you want to be smart with that. And again, I'll go back to that statement I said earlier. You have to be able to have a candid conversation with your lender to make sure that they're not just saying, hey, you qualify for a $400,000 house, go buy the best house on the block. And then 6 months from now, you're struggling with it saying, why did I buy a $400,000 house? It's too big for us.
Yeah, that makes sense. Now, when someone is coming and applying together with a co-applicant, how does that get factored into your debt to income ratio? So, or if someone wants to buy it by themselves but can't qualify, how does bringing on a co-signer help with that?
Yeah, that another good question there. So lenders take the lowest credit score of said buyer, whether that's the individual buyer or a husband and wife or two folks that want to just move, buy a house together currently, that you take the lower of the two scores. So, if this person has a 700 middle score and this one has a 680, we're taking the 680.
Okay.
The total income is put in there from both parties, and their debt is put in there from both parties. And so as long as all that combined keeps the debt ratio under 45%, and you're still able to get the automated approval through DU or LP, then you will be able to get that house. But that's typically what takes into play. So that, if you have a husband and a wife on it, and the wife has incredible credit, but she chooses to work at home and she chooses to take care of the children and all of that sort of stuff, and the husband has all the debt and all of that sort of stuff, and he has a little bit lower of a credit score, they're going to go off that credit score. And then the other side of it, bringing somebody on that does not have money sometimes doesn't really help, even though they could have an impeccable credit. Hey, grandma doesn't mind being on the loan for me, or my mom and dad don't, but they have other debt that you might not see. Again, I kind of go back to talk to your agent, talk to your lender, say, how can we get this done? Because our job's to find a path to qualification so that you can get that house. But as far as just from a credit score standpoint, if you have multiple people on the loan, they're going to take the lower credit score of the two.
That's good to know. Yeah, that's helpful for sure. Well, excellent. Any other tidbits you want to share about conventional loans, or do you think we pretty much covered it all?
Yeah, I think we pretty much covered it all, right? I think it's the appraisal's easy. The qualification is pretty simple. I put one in on Monday. We already got it out of underwriting. So the turn times and all of that, even with all this craziness out there, the process is so automated these days that once you have the right path and you get a quality approval letter, get it in. Let's rock and roll with it and get you closed and into that new house for hopefully by the summer when everything's opened up, the pool's open, you can go live life, right?
Yes, exactly. Well, thank you again. If anyone has questions, or if you want to find out if what will be best for you and what will work for you, feel free to reach out to Rich or myself. Our contact information is below, but we're happy to help you. And I think we froze, but I think we're back.
No, you're good.
So it was great again, Rich, to chat with you.
Absolutely.
And until next time, we'll see y'all later.
Well, perfect. Y'all stay safe out there. Thank you so much.